Good morning. I'm Gord Long with the Financial Repression Authority. I have with me this morning Dr. Lacy Hunt joining us from Austin, Texas. Lacy is an internationally known economist and executive vice president of the Huntington West Investment Management Company, a firm that manages over $5 billion for pension funds, endowments, and insurance companies. Welcome back, Lacy.
Nice to be back, Gordon. Thank you.
How quickly the time goes, and it's always a pleasure. I want to talk about your quarterly report, an absolute must read for any of our listeners. It's free. It's on the site, on your site, the Huntington website. But before I do, for some of our listeners, we have so many new listeners, Lacy, that may not be familiar with yourself and Huntington. Can you just give them a brief overview?
Well, I earned my PhD when I was 26 from the Fox School of Business and Management at Temple University. From there, I went into the Federal Reserve Bank at Dallas, and from there to the econometric subsidiary of Chase Manhattan. That was in the days when Chase was run by David Rockefeller. I became the chief economist of the largest bank in Philadelphia, and then the chief U.S. economist for the HSBC group in the days when HSBC was run by Sir William Purvis. I've been with Huntington Management for 20 years now. I'm a native Texan. I've written extensively, been published in some leading scholarly journals like the Journal of Finance, the Financial Analyst Journal, been published by the Federal Reserve Bank of Dallas, the Board of Governors of the Federal Reserve, and I've been on the front line in a lot of tough situations in the financial markets. When I went into the Federal Reserve in 1969 with my new PhD, William McChesney Martin.
Oh, yes.
Fighting the Vietnam War inflation. When I left the Federal Reserve, Arthur Burns was still dealing with it, or the remnants of it. I've had the privilege of knowing a lot of the great economists of our day, and I greatly enjoy what I do.
And Huntington as a company?
Say again?
And the firm that you're with, Huntington in Austin?
It's a very comfortable situation. Austin's a beautiful town. My home is a short drive from where I work. Couldn't be better. A lot different when I was in New York City, and I had a 2-hour commute from New Jersey suburb to 140 Broadway.
Well, looking at the background behind you, I can see why you love it. It just looks absolutely beautiful where you have your offices. Lacy, I want to jump right in because we're always short of time and talk about your report and kind of step through the highlights of it, if you could comment on them. And you start by really talking about the U.S. and the global economy. And after spending, taking up the national debt from just under $10 trillion to just under $19 trillion right now, we really haven't seen the kind of rebound or growth that we should have or could have expected. Comments on that?
Well, I didn't think the debt was helpful. Debt is a very treacherous thing. Debt only works if it generates an income stream to repay principal and interest. Otherwise, all debt does is transfer spending from the future into the present. You get an up cycle now and a down cycle later on. If you go through this many times, you get an excessive buildup of debt. A lot of academic research indicates that when public and private debt rises above 250 to 275% of GDP, has a very deleterious effect on growth. All of the major areas of the world now are outside this range, including China. The U.S. public and private debt's about 375% of GDP, 100 points higher in Europe. Japanese public and private debt is on the order of about 650%. And I think there is not one scintilla of evidence that an indebtedness problem, a massive global indebtedness problem can be solved by taking on further debt. And we do not have the political will, the political leadership to tackle the debt problems, and consequently, they're likely to be very persistent.
Lacy, one of the things that really stands out in the article is you cited work from Spence and Warsh, and that is that we've transferred the money that has been spent in terms of this debt buildup has really moved from the investments from real assets into financial assets. And you actually cite 4 key points on that of why that is. Could you take us through that if you could?
Yes, I'd be pleased to do that. What we're talking about here is the impact of quantitative easing. One of the objectives of quantitative easing was to boost the stock market, on the theory that if we got a higher stock market, this would raise wealth, and the increase in wealth would increase consumer spending. Well, it was always a dubious proposition that there was any sort of wealth effect. The majority of our people don't have enough stock to cause them to alter their consumer spending. And while the wealth effect is a theoretical possibility, it's never been measured by empirical studies, or except in a very minute way. In fact, last year and the year before, if there were ever a time that the wealth effect should have been operative, were 2014 and 2015, because we'd had a huge run-up in stock prices, yet consumer spending faltered in both years. That's typically the case. But the other mechanism was that somehow, by buying government securities, the Federal Reserve was in a position to cause the stock market to rise. Well, when the Fed buys government securities, the process basically ends there. They cannot print money. They do not have the mechanism to print money. They do not have the tools to print money. They can buy government securities and force the banks to exchange government securities for a deposit at the Fed. In other words, cause the banks to surrender one type of government asset for another type of government asset. And as Chairman Bernanke said in a interview on 60 Minutes a number of years back, after they buy the government securities, all they can do is hope that they get the result that they want. In other words, there was no mechanism to explain why quantitative easing should boost the stock market, but yet we saw that it did. And so what Spence and Wash were able to explain, provide us a causal explanation of why empirical studies showed that quantitative easing had contracted the economy, was in fact supported by causal data. And so what happened is the Fed gave a signal to decision makers that we're going to protect financial assets. And all the decision makers have to figure out is that the Fed cannot extend that protection to investment in plant and equipment and other real assets, let alone the broader economy. In other words, they incentivize the decision makers to view financial assets as being more valuable than real assets. And so what they did, the decision makers, is they transferred funds that would have normally gone to the real economy into the financial economy. And as a consequence, the rate of growth in earnings in this expansion of the S&P 500 was considerably worse than before. This was the worst expansion for a non-residential fixed investment. And as firms had learned, when you're in difficult straits, it's very difficult to obtain liquidity from real assets in a distressful situation. You may not like the bid, but liquidity is there for financial assets. Mm-hmm. And so firms gave preference to the more liquid financial assets, assuming, and because of the Fed's guarantees to them, or assurances to them. It made the financial assets returns less volatile than real assets, which added further to the appeal of financial assets. And so, in essence, the way in which it worked was by signaling that the real assets were inferior to the financial assets. And so we've seen in recent years where more than half of cash flow has gone into financial engineering. It doesn't boost productivity, it doesn't boost employment, does not boost the rate of economic growth. In other words, what the Fed did by going to an untested program of quantitative easing, they actually made things worse off.
That's a stunning revelation, and the evidence seems to be clearly there. As an observer internationally, as much as quantitative easing has brought supply or demand forward initially, we can question whether it does or damage. What we've seen is it brought supply it built supply dramatically up. In other words, cheap money doesn't just help possibly consumption. What it really helps is the build out of supply, and that has been dramatic on a global basis of companies that have expanded where they probably shouldn't, and the creation of what we call malinvestment. Comments on that?
But that's another aspect. I think that the prolonged period of zero interest in giving forward guidance that interest rates would be low for a very, very long time served together to create malinvestment and overinvestment. And that's clearly one of the problems in China and Japan, the emerging markets of the world. When the major economies faltered in 2008 and 2009, this had a serious impact on China and the emerging economies because there was no engine of growth in the industrialized world. And so what China and Brazil and Russia and Turkey and a whole host of emerging economies did is they chose the heavy debt option. China, for example, in 2008, public and private debt was about 80% of GDP. In the early part of last year, it was 320% of GDP. So China financed a great expansion of their productive capacity. And they added to it actually during the course of last year with further additional increases in debt. And there's nowhere for the output of this capacity to go. Creates excess supply, and now it's obviously clear that the economy has been mismanaged, that debt is not a further option, and so all of the economies of the world, industrialized and emerging, are simultaneously over-indebted, and the world does not have an engine of growth to get out on front. And that's exactly what happened in the period from the mid-1920s until the start of World War II. It's not a very healthy situation at all.
We're seeing a flattening of the yield curve. Do you see that continuing? And when I say flattening, I'm talking about the 210 curve right now that seems to be putting in almost a triple bottom as it's testing, dropping even further.
Well, monetary policy right now, in terms of its capabilities, is asymmetric. If the Fed tries new schemes, another round of quantitative easing, or perhaps going to negative interest rates, or some sort of hybrid of the two, the evidence is overwhelming. That will not make things better off. That will make things worse off. However, if the Federal Reserve wishes to constrain economic activity, to tighten monetary conditions, as they did in December, those mechanisms are still in place.
And possibly even more effective than ever.
They are more effective because the domestic and global economy is more heavily indebted than normal. Public and private debt, as I said, is 375% of GDP. From 1870 through 2014, debt only averaged about 190%. So we're carrying inordinately high debt levels. So a small increase in interest rates reverberates through the economy much more quickly. Your point's very well taken. So if the Fed wishes to tighten, which they did in December, they do the old traditional things, the things that have been tested and which linkages do exist. So they contracted the monetary base very substantially. That will ultimately put downward pressure on money and credit growth as we move forward in time. They managed to raise the federal funds rate, and they had a particularly pronounced impact on the short intermediate term treasuries. The Fed's influence on the long end is very minimal, but the shorter the maturity is in relationship to the federal funds rate, there's an impact. And so as the Fed was telegraphing that they were going to raise the federal funds rate, even before they did, that had the effect of raising the intermediate yields, but the long-term yields didn't go up. So what happened is the yield curve flattened. The intermediate moved up toward the long-term rates. But that has negative consequences in and of itself. First of all, it makes the banks less profitable because the banks borrow in the intermediate end and lend in the longer end. And so if the yield curve flattens, it reduces their profitability. And as this process takes place, it's also a signal from the marketplace that the market believes that the outlook is for lower growth and lower inflation. So when the Fed tightens, they have an impact. They have a quick impact. When they ease, they have a negative impact. Monetary policy is now asymmetric.
We saw it so clearly at the Financial Repression Authority when they started talking, the Federal Reserve, about taper. And it's starting to become a real possibility. We started seeing commodities dropping off and then steadily accelerating. And then as they accelerated and we actually started, we finished taper, then we saw the high yield market really get into what I'll call some serious problems, and specifically commodity and oil players, that sort of thing. Now, Lacy, your conclusion from this is that you see downward pressures on the longer term U.S. Treasuries right now, and that's counter to what everybody else. Everybody thinks that yields are going higher and prices down. That's not what you see.
Well, the critical factor for the long bond is the inflationary environment, and last year was a disappointing year for the economy, and moreover, the economy ended on a very low note. We had a drop in the rate of growth in nominal GDP, which is our best measure of economic performance, from 4 to 3. The fourth quarter was very poor in terms of nominal GDP growth. Real GDP growth fell about 50 basis points. The inflation rate was down 50 basis points. We saw a contraction in the manufacturing sector. A lot of folks like to point out that that's only 10 or 11% of employment, but it's 25% of the value added, according to the figures of the Federal Reserve, and more than 60% of the profits of S&P 500 companies. And the manufacturing sector contracted. If we exclude the automotive sector, where it was buoyed at least for the first part of the year by a lowering of automobile credit standards to the weakest point in 10 years, also according to the Federal Reserve, the manufacturing sector contracted 2.5%. Those are large declines. The global economy had the worst performance since '09. And there were out manifestations of the weakening in economic activity. One impartial measure is what happened to commodity prices. Commodity prices are, of course, influenced by both supply and demand factors. But when there are broad, steep declines in virtually all of the major indices, that's an indication of lack of demand. and the Goldman Sachs S&P index has fallen back to where it was in '04. The somewhat differently measured Bloomberg index, which does include the precious metals, is the lowest point since the series been measured in 1991. And that's all indication that what the Fed did is they tightened monetary conditions into a weakening domestic and global economy. In other words, they hit it when it was already receding. And that will tend to further weaken the almost non-existent inflationary forces, which for an investor in long-term bonds, that increases the value, doesn't diminish the value. And that's why the hike in the federal funds rate did not lead to an increase in
the history books may not be very generous to this recent Fed policy. If in fact we fall into potential recession, and what we're in the United States, and they have to reverse. But what we've seen is a complete lack of pricing power that's taking itself around the world, and that bodes poorly for trying to increase inflation. It says falling or even weakening inflation. That's what we see as laymen on a general day.
We absolutely do see that, and the lack of pricing power is as much an economic barometer as any economic barometer you have. If you don't have pricing power, it's an indication of hard times, and that's what we have. And in that sort of circumstance, the Federal Reserve is really not very equipped to deal with it. You know, the fact that the Fed made what appears to have been an ill-conceived move in December really should not be surprising. Two outstanding economists at the Federal Reserve Bank in San Francisco did a detailed study of the Fed's 4-time-a-year forecast that they've been making since 2007. They've missed every single year. They've been overly optimistic, widely optimistic. The Fed starts off at the beginning of the year with a high forecast, and then as you go through the year, they lower the forecast. By December, their forecast is not too bad, but then it's not a forecast anymore because you already have 11 months of data. But the Federal Reserve apparently is not able to analyze where the economy is going. And I think one of the indications, one of the empirical indications that quantitative easing and forward guidance has failed is the fact that their models have relied on them to be efficacious, and the models were wrong, which means the policies were also.
The only organization that has a worse track record for forecasting than the Fed is the IMF on global growth, which has been, well, it's just as atrocious. Lacy, in closing, are there any key messages you'd like people to take away from your report?
Well, I think that there is a risk in weak economic times that the Fed will continue untested experiments. Even though the evidence is that quantitative 1, 2, and 3 failed, in dire circumstances, they will go to quantitative 4, simply because it's a tool that they can use. That's tragic that they put themselves in this situation, but I could see them doing that. Another risk that we have, and the result will not be any better, in fact I think it will be worse, is that the Federal Reserve could go to negative interest rates. Now, we first should consider whether the Fed can engineer negative rates. I think they do have that ability. The so-called IOER, the interest on excess reserves, the Fed is currently paying 50 basis points, but they could charge a safekeeping fee of 50 or 100 basis points. They could pull that rate negative. I think that would drag the short rates down with them. The problem is that there will be severe repercussions. In fact, we won't even be able to anticipate all of the repercussions. You're going to have an adverse impact on bank earnings, particularly the small banks. You're going to greatly harm the small savers who have already been adversely affected. The quantitative easing, encouraged the shift from real assets into financial assets. That boosted the high-end households, but it penalized the grand majority of our people. Negative interest rates would do that in an even more serious way. It will have devastating consequences for the money market mutual funds. It's very difficult to see how they would operate at all if they have to charge 50 basis points or 100 basis points.
Well, the 2008 crisis was kicked off with breaking the buck on the money market funds, as I recall.
And the insurance companies in time would be hurt. Pushing the rates into negative territory will greatly increase the unfunded liabilities of the corporate pension plans, which means they would be more underfunded, and pension plans would either have to be dropped, but even for all those that are already covered, it would explode the liabilities. They would have to then cut expenditures in the real economy to fund the pension liabilities. And I think if the Federal Reserve were to go to negative interest rates, other than for just a very short period of time, they ultimately would be required to call in the currency and force people to just simply use with bank deposits, because over time there would be a massive disintermediation from bank deposits and short-term investments into currency. We're already beginning to see that in parts of Europe. There would be other unintended consequences. In Switzerland, for example, where the overnight rate is negative 1.5%, the Swiss banks tried to go to negative rates for the small depositors. There was such a uproar and negative reaction that the Swiss banks went ahead and continued to pay them a very minimal positive rate. But to cover that cost, what they did is they jacked up the rates on mortgages. Entirely the opposite effect. In other words, instead of making home buying more affordable, it served to make it less affordable. And so basically, regardless of what they could do, the options appear to have far more negative consequences than positive. In other words, we're no closer to a fundamental resolution of our indebtedness problems as we enter 2016 than we were when we entered 2009 or 2010 or any other time. The debt levels continue to grow. We're not going to solve an indebtedness problem by taking on more debt.
It seems obvious, but somehow it seems to be startling news to some people. Lacy, we have to break here. Could you just tell our listeners how they could follow your work and get your quarterly report?
A letter on our website, Hoisington Investment Management Company, and we do that as a public service if they want to read it. But we're not in the mind-changing business. We're in the investment management business. We're trying to execute a fiduciary responsibility to the clients that have placed their funds with us.
So you're not selling anything or spinning it. You're just trying to get the facts out. That's a unique today. Lacy, thank you very much for the time. I know you're rushed here this morning, and I really appreciate you taking the time.
All the best, Gordon. Thanks.
All the best. Talk to you. Bye-bye.
Bye-bye.